Hello everyone, this is Richard K from Price Action and Income, and today's video I want to talk about Japanese candlesticks. Give you a bit of their history, how traders tend to use them to spot potential reversals, and how I like to use them as an entry confirmation condition that I need to see before I will enter into a position. Now, Japanese candlesticks, or candlesticks for short, have been around for a very long time and was apparently developed in the 18th century by a Japanese rice trader who plotted hand-drawn charts displaying the fluctuation of rice prices. Now, although candlesticks have been around for many years, it wasn't until much later that a gentleman by the name of Steve Nissen introduced candlesticks to the Western world in his book called Japanese Candlestick Charting Techniques. The rest, as I say, is now history, and the use of candlestick charting has become widely adopted by traders from all over the world. For those of you that are new to trading, let's first look at how candlesticks are displayed on a chart before we move on to how they can be useful in trading. So on this chart, as an example, I've opened the Euro-US dollar currency pair, and this is set on a daily time frame. So each little candle or long-bodied candle that you'll be seeing here, you'll see they're colored in different colors, displays a 24-hour trading period. Now, if you would set this to a 4-hour chart or a 30-minute chart or whatever your preference might be, then it would just display a candle and what price was doing during that time period. Okay, so first off, you'll see that I've got a red candle over here, and how candlesticks are often or should be read is from the left-hand side to the right-hand side, because obviously this would be history, and let's say this was the current price over here. When this candle closed, the next candle started, and this would be your opening price, read from the left to the right on this flat little top here. In this case, that had a very wide-ranging body colored in red, which is called the body of the candle. And then when price ended a 24-hour session, or depending on the time frame you looked at, we'll have a closing price before the next candle then, or next day in this case, started. Now, price actually went up as high as this area and as low as this area, but it was only, the candle would only be marked using where price opened and where price closed. So the uppers and the lower excursions of where price have been are what's called the wick, or wicks in this case. On the right hand side, we'll have exactly the inverse of the red candle, green this time showing an upwards price movement. Again, red from the left to the right, you'll have an opening price. Again, we'll have a pretty large ranging body colored in green, and then price went as high as this excursion over here, which is then left a wick. Price came down a little bit, and it closed by the closing price, this little horizontal area before the next candle started again. Now, traders will typically try to spot groupings of recognizable candlestick patterns that tend to pop up at levels where a reversal might appear. Candlesticks can therefore tell a story or provide clues as to what's happening as traders juggle between buying and selling any particular market. I'm not even sure how many candlestick patterns there are out there, but books have been filled with all different kinds of candlesticks which carry weird and wonderful names to describe them. I only tend to focus on 4 patterns that I want to see at important levels or areas that I'm interested in trading. On my next chart, I simply pulled up a section of data on the Euro-US dollar and marked out the 4 patterns I like to see. I even named them in a way that I can remember, but feel free to call them by their other exotic names if you wish. I just like to simplify things for myself. First up is what I call the reversal candlestick pattern. And this is this little red one, in this case a price moving lower, that I marked on my chart. Now, a bearish reversal candlestick, in my case, the way I see it, will typically appear at the end of a move. In this case, price went upwards and then reversed lower. But the wick of the candle actually went higher than the previous price. Price opened here from left to right, we're reading it. The wick, it went up as high and excursioned as high as the previous candle's high, and then moved lower, leaving what I call a bearish reversal candlestick. Secondly, I like to spot what is called an engulfing candlestick pattern. And in this case, of reverse of what the other one did, this case upwards, price or the body of this green candle was much larger than the preceding candle's body, which was down, and then immediately price followed, reversing higher with a much bigger body than the previous candle. And this is what's called a bullish engulfing candlestick. Then thirdly, I like to follow what's called a flanked doji pattern. This actually consists of three different three different candles forming one formation, which I call the flanked doji. Now, a flanked doji can easily be spotted by price moving up into a high. Then the bar after that is got a very narrow range to almost no body, like you can see here, which we call a doji. And then immediately afterwards, price reverses slower. With a red candle in this case, obviously the inverse would be true if you were going upwards, and basically flanking both sides of the doji. That's what I would like to call the flanked doji. And lastly, I like to see what is called a hammer candlestick pattern. And in this case, it's just a single formation or single candle that indicates what looks like a hammer. You'll see that there is two different types of hammers that you get. The one that is a hammer, and this, as I would probably guess they call it, looks like the top of a handle with a long handle on it, which in this case is just a wick. And then we'll have an upside down hammer, which is called an inverted hammer. And in this case, it had a green body with almost no wick at the bottom, and this is how hammers are identified. They leave little to no wick at the tops of the heads, or in this case an inverted hammer. And then again it had a long wick with a very sort of small body, which they call the head of the hammer. And that's what we call either the inverted hammer or the hammer pattern. Now, one thing that I want you guys to take note of is that these patterns can actually pop up at any time on a chart. So how would you then really know that a potential reversal might be on the cards? And the answer to that is that candlesticks need to be used in conjunction with other analytical techniques. Now, whether it be indicators, or in my case, I like a combination of using one indicator, market geometry, and price patterns to confirm when these patterns actually pop up that they have a high probability of reversing a trend or an actual correction. On my next chart, I pulled up gold using the spot price set on a 4-hour time frame. And this is where I would like to show you how important candlestick patterns assist me in my trading decisions when they appear at important levels that I identified beforehand. I have been tracking the price action in gold since the high that was made on the 25th of June this year. Price then started moving sideways and started contracting in a narrower range as time progressed. It wasn't until around the 11th of June that I started formulating an entry plan, because the pattern I was tracking resembled that of a symmetrical triangle correction, which is labeled on my chart as A, B, C, D, and E. Now, these triangles create high probability setups if you know what to look out for. There were clues all along the way that increased my confidence that such a pattern was underway when price started contracting and respecting important fib retracement levels. To display that to you or show you that, let me just pull up my fib retracement level, and as you'll see, I tend to go in between the waves, like from A to B, for example. Price struggled to get through the 0.786 fib retracement level and went higher. Now, at this stage, this could have just been a correction and price could have just moved higher from there. This is why it's important to then again use your fib retracement. In this case, you'll just go from the B wave, and then at this time I assume this might be a C wave, and price moved higher up into the D wave, which I then labeled when price started moving lower, because price again struggled to get through the 0.786% level. And it's normally at this stage, when I assume that I have a D wave, that I can then start planning an entry if I would get an E wave, which normally ends this correction before price shoots up again and continues an upwards trend. Once I assumed that the E wave was underway before the end of this correction would end, I then simply just connected my C wave. Sorry, let me just get that right. to my D wave, and I then would know that this correction carries a high probability at ending at either one of the fibs at the lower level, and I really like to target the 0.618% fib retracement level, which is also known as the golden ratio. Once I have identified a level for a trade, in this case to buy gold, I then wait for price to move downwards towards my level, where I then switch to a smaller time frame, like the 30-minute chart, and add the only indicator that I use, namely the MACD. And I use this indicator to spot a condition called momentum divergence. You will also see in my chart that I drew in a wide channel line here, the ones in green, the upper channel line, a lower channel line, and I simply connected that to the top of what I assumed the D wave was, found the angle at the slope at which this movement was going lower, and brought the lower channel line to this low over here, and this even made the trade more accurate when price moved down into the 0.618% fib retracement level, which was also confluencing or in confluence with the actual center line of my channel. Now, as price came down from the D wave, momentum started off quite high, as displayed in the lower panel over here, and price in this example reached the 0.618% fib level for the first time on very slight momentum divergence. But since the waves that make up a triangle tend to move in zigzag movements, I had to wait for a second touch of that line at the very least. Price then went up a little bit, and then eventually came down again, touching the fib line on a second occasion. But this time there was no noticeable divergence, therefore not allowing me to take a trade or allowing me to enter into any position. But look what had happened when price touched the fib for the third time around. There was momentum divergence. Let me just draw that for you guys between this low and the final low that ended yet again at 0.68%. And in this case, we had much more noticeable divergence on my momentum indicator, in this case the MACD. And what we also had, and this is where the candlesticks play such an important part. Let me just zoom into the chart a little bit more. We had what we call, or what I call, a flanked, bullish in this case, doji formation. All these various conditions then signal to me that it was time to enter a long position. And I like to generally enter a position after I have a confirmation entry pattern, in this case the bullish flanked doji formation. Just take my magnet mode off. There was an entry right on top of the candle, and as you will see, price just shot straight up and never looked back. Now, where would I place my stop loss in this case? I tend to like using or placing my stop loss below the actual lower, in this case a trend line of the actual triangle. There was also a 0.786% fib retracement level there, and I positioned my stop loss, just color that in red, just slightly below them. And what I tend to do in the majority of the cases is then place my targets. Let me just go back to a 4-hour chart so you can see this better. Bring that up higher. Open it up. And then target the beginning of where this entire correction started from. And in this case, you'll see that this left behind a pretty good risk to reward ratio, and price had absolutely no problem getting there. I had a very good risk to reward ratio. Price shot up straight upwards, and with a very tight stop, I managed to enter right at the end of this correction, which is why it's so powerful to use a combination of different entry conditions, like my MACD, a little bit of market geometry, my Fibonacci lines, and as well my last condition that I require, and in today's topic we're discussing candlestick patterns. Okay guys, so that in a nutshell was just a quick rundown of how I incorporate Japanese candlesticks in my own trading plan, as they form an integral part of my entry confirmation process. And if you are new to trading these Japanese candlesticks, They can be a powerful way to assist you in your own trading decisions, but just be mindful that they need to be incorporated as part of a strategy, and I hope that what I've shown you today will assist you in doing just that. If you liked today's video, then please hit the like button below and subscribe to my channel for some more insightful videos in the future. Until next time, this is Richard K from Price Action and Income. Goodbye.